In our final market update for 2024, when we looked ahead to see what 2025 held in store, we identified the fact that there was an important cycle trough that was looming ahead in about the first half of this year. And as we approach that trough, it seems that the markets have indeed turned down in order to find their way into that important cycle trough. This poses a new problem for us as cycle analysts as we try to identify cycle troughs in a falling market. That is what we are going to be looking at in detail in today's market update. Here is the S&P 500. We're looking at SPX data, as we always do, and you can see that the analysis has shifted slightly. The reason for this is, of course, this continued downward move over here that we have experienced over the past 2 weeks. In my previous market update, I discussed the possibility that this trough over here could have been a greater magnitude trough than the 20-week cycle trough that we were considering because of those circles and whiskers. Now, in this analysis update, you can see that the trough has been upgraded. I have hidden the 18-month cycle and longer because I'm not confident about the placement of those cycle troughs. However, the important point is, as discussed in our previous market update video, the possibility of asymmetrical price action developing. That is a constant danger that lurks in the back of the mind of a Hurst cycles analyst, because cycles do lead us to expect some symmetrical price action, because of course a cycle will cause price to rise and then to fall again. And so what we have experienced here in the 40-week cycle that elapsed from April until January of 2025 is, of course, an upward price action. Here is the danger that we are going to see a symmetrical price action. Now, symmetry always breaks down at some point, but so far the price action that we have seen playing out this year is fairly symmetrical, providing a warning, of course, that we have more bearish action ahead. Here is that major trough that I mentioned earlier. It is now still expected in about May of this year. Price should now be forming a trough of 80-day magnitude. But let's zoom in and take a closer look at that potential 80-day cycle trough. In my previous market update, which was recorded on this date over here, we were considering the position of the 40-day cycle trough. Price has kept moving down, as you can see, and is now, of course, headed down into this expected 80-day cycle trough. The 40-day cycle trough has been phased over here at this rather unsatisfactory position. Which brings me to the main subject of today's market update, which is identifying troughs in a falling market. Given the overall picture that we looked at a moment ago, we know that there is bearish pressure as the market is brought down into the cycle trough that we are expecting in May. When there is bearish pressure, cycle troughs become difficult to identify. We can see this happening at this zoom scale. In simple terms, the current 80-day cycle that started on the 13th of January caused the market to rise and then to fall. However, somewhere round about the middle of this, there should have been a 40-day cycle trough. And so the way that 40-day cycle trough usually manifests is that price will rise up and then fall down into a 40-day cycle trough, then come back up again and then continue moving down, giving us the expected M shape. But now on its way down into this final cycle trough, the 80-day cycle trough in this example, there must be, of course, a 20-day cycle trough that should form as well. That gives us extra kinks in our cycle action. On the way up, we should see what Hurst called a mid-channel pause, and on the way down, we should also see a mid-channel pause. There is some evidence of that mid-channel pause occurring in this price action. But of course, as the market is moving down into an important cycle trough, the shorter cycle troughs become difficult to identify because of the fact that the bearish pressure of the longer cycles limits the bounce out of those cycle troughs. Which brings us to this 80-day cycle trough that is forming now. We need to bear in mind the fact that there is still a big cycle trough looming in May of this year, and so the bounce out of this 80-day cycle trough might itself not be very impressive. We will, of course, be watching our FLDs for evidence that that cycle trough has formed, but we must keep in mind the overall bearish pressure. There is another interesting thing that has happened in recent weeks, which has to do with the value of the dollar. The S&P 500, being an index of US stocks, is of course effectively valued in the US dollar. In the past few weeks, the US dollar has devalued tremendously, and this highlights an interesting aspect about our approach to the markets. We are identifying changes in value, which are clearly influenced by cycles. However, all value has to be expressed relative to something else, and the S&P 500, although it is not priced in US dollars, is effectively valued in US dollars. When the value of the US dollar changes relative to other currencies, we get a more complex relationship between the shifts of value in the S&P 500 and the dollar compared to other currencies, which is why I like to track the value of the markets that I trade compared to other currencies and even other commodities. This is a chart of the S&P 500 valued not in dollars but in euros. I won't go into detail here because that would make this video much too long. But the interesting thing is that we have an important cycle trough again on the 13th of January. Notice, however, what happened last week. That is that the value of the S&P 500 or SPX, valued not in US dollars but in euros, actually turned up. And so the SPX itself fell last week. The value of the SPX fell. But the reason why it fell is because we were valuing it in dollars, and the dollar itself lost value. When valuing the SPX in euros, however, because of the relative increase in the value of the euro, we have a potential cycle trough that has formed. As you can see from this nest of lows, that is, of course, expected to be the 80-day cycle trough. I point this out because it is quite possible that these cycle troughs are forming in the stock markets themselves, but because of fluctuations in currency values, we are going to find it difficult to identify the position of these cycle troughs, both because the market itself is falling, but also because the basis upon which we are calculating the value is itself changing. In the Nasdaq, our analysis has not changed. You will remember from previous market update videos that we have been considering the 20-week cycle trough as having formed over here in the middle of December. That gave us a 40-day cycle trough over here towards the end of January, and the Nasdaq is itself still falling into this 80-day cycle trough. This nest of lows is of course stretched over to the left, indicating that we have a fairly late 80-day cycle trough still forming. But again, the Nasdaq is of course also valued in the US dollar, and as the US dollar has taken a dramatic loss in value recently, it is just possible that this 80-day cycle trough has in fact formed in the market, but that we are not seeing it on this chart because of the changing of the underlying value. The important thing in the Nasdaq, as in the S&P 500, is that we have this big trough looming ahead of us, expected again sometime in May or early June. Although we are expecting an 80-day cycle trough, it would be a little foolish to be jumping into long trades just yet because of the fact that we have that looming cycle trough ahead of us. But certainly we will be watching how price interacts with FLDs as the potential 80-day cycle trough forms. I have been enjoying watching the Australian stock market. This is the ASX, and it has given us an interesting comparison with the US markets over the past several months. In our previous market update, which was recorded 2 weeks ago, that's over there, we were looking for the 80-day cycle trough to form. Here is that circle and whiskers for the 80-day cycle. You can see that we have a staggered nest of lows. That is because it would seem that the shorter cycles, 40 days and shorter, have been expanding and pushing this trough further out and to the right. Price has continued falling for the past 2 weeks into this 80-day cycle trough. The Australian market gives us the clearest illustration of the danger of asymmetrical price action forming. Here is our 20-week cycle that elapsed from August into the middle of December, with the timing of this 20-week cycle trough the same as we have it in the Nasdaq. Here is the second part of the M shape. This is not a perfectly symmetrical price action, but you can see the symmetry has taken hold as price has dropped down from the second peak. Of course, in the Australian market, we have been speaking for some time, since the end of last year, about this very important cycle trough that looms ahead, as it does in all of the stock markets that we have been tracking. This is a trough of 40-month magnitude, in my opinion. We don't have time to discuss the slightly different nominal model that I used to analyze the Australian market in this video, but here is the nest of lows. It is slightly staggered from the 80-day cycle and longer. You can see it is centered around about the end of April, early May. The 40-day cycle and shorter cycles have been stretching, as mentioned, indicating towards the end of May, and the circles for the 18-month and 40-month cycle troughs are off to the right-hand edge of the chart, indicating that they are expected even later. Nevertheless, in the ASX, as is the case with the US markets, we are going to be watching carefully to see whether price does manage to bounce out of this 80-day cycle trough. Here are the FLDs that we need to keep our eye on. The 20-day, the 5-day, and even the longer FLDs are, of course, forming a cascade pattern. And as price potentially forms an 80-day cycle trough and starts crossing up through these FLDs, we can gauge the strength of the bounce, bearing in mind that we have a big cycle trough looming ahead of us. There is not really very much to add when it comes to the Nifty that we have also been tracking in recent market updates. Here is our 40-week cycle trough in August of last year. This is the 20-week cycle trough that we spoke about in our previous market update. And again, we have seen bearish price action. The reason for that is, of course, the pressure of the longer cycles. Here is our very big nest of lows for the very important cycle trough that we are looking at forming later this year. You can see that the Nifty differs slightly in the shorter cycles. We are expecting a 40-day cycle trough to form around about now. We have an 80-day cycle trough towards the end of April, but we have the very important cycle trough expected, in this case, in about July of this year. Of course, as we approach these longer cycle troughs, we can refine our understanding of exactly when that cycle trough will form. If we zoom in on the Nifty and take a look at the 20-day FLD, you can see that price has now come up to that 20-day FLD. We would expect it to cross above the FLD at this time, but given the bearishness of the market, it might fail to do so. You can see that so far today, it has not managed to get above the 20-day FLD, even though we would expect it to cross above, but the bearishness of the market is clear. In gold, we have been discussing recently the shift from a trough-based analysis to a peak-based analysis, and in our last market update, I was discussing the important cycle peak that we were expecting. We had a bunch of circles and whiskers, a nest of highs up here for this peak. You can see that in this analysis, and this is a weekly chart, that important cycle peak has been positioned. Does that mean that the peak is definitely in place? No, not necessarily. Whenever a peak or a trough is positioned, it means that the software finds enough evidence to position that peak or that trough there. But the fact that these are hollow triangles, in this case marking that peak, warns us that it is a slightly tentative placement of that cycle peak. If we zoom in, we can see how price crossed down below the 20-day FLD. As mentioned in the past two market updates for gold, we were waiting for price to confirm that the peak had formed by crossing down below the 20-day FLD. But to confirm a 54-month cycle trough on the basis of price crossing a 20-day FLD would be a little foolish and premature. We have an interesting interplay between the trough analysis and the peak analysis here, and you can see that according to the trough-based analysis, price came down into a 40-day cycle trough over here. it crossed below the 20-day FLD, accurately achieved its target, which is what is expected to happen. That doesn't indicate that a tremendous amount of bearishness is present yet, and so it could be that price, when it crosses back up above the 20-day FLD, reaches even a little higher and forms a slightly higher peak, in which case, of course, this marking of the peak is incorrect. The important thing is that we are certainly standing by for an important change in gold, and we will continue to monitor the interactions between price and the 20-day FLD to give us a shorter term perspective. We have a 20-week cycle trough which is looming towards the end of March or early April, and when gold turns down into that trough, we will have a better idea as to the magnitude of this peak. Bear in mind that this price of gold that we are tracking is also quoted in US dollars, and so we are considering the value of gold relative to the US dollar. As the US dollar itself changes in value, that is going to influence the price of gold as well. Finally, Bitcoin has also been demonstrating the rather scary symmetrical price feature. I discussed this in previous market updates with Bitcoin. We had a move up from the 18-month cycle trough phased in August. We came down into our 20-week cycle trough that we have been considering at that position for some time. We had price come up to form an almost symmetrical double peak, and then it, of course, turned down. I highlighted the danger of this symmetrical price action in the previous market updates, and here you can see the composite model line, which takes all of the information from the cycle analysis, recomposes it, and shows us what would be expected to be happening in this market in the past, and extending that into the future if the only thing influencing this market was the cycles. Of course, other things are also influencing this market. Again, we are looking at Bitcoin relative to the value of the US dollar. And so we have the interesting interplay of the value of Bitcoin and also the value of the US dollar. The interplay between those two different relative values is giving us our price action. The important thing about the US dollar is that it seems it is still continuing down into an 80-day cycle trough expected in early April. We have again an important cycle trough, in this case of 40-week magnitude. We have a rather staggered nest of lows, making it difficult to estimate the exact time of this 40-week cycle trough. But as we are able to identify the position of the shorter cycle troughs, we will be able to refine our understanding of when this longer cycle trough is expected to form. At present, it is expected probably sometime in June, as can be seen in the composite model line over here, with this trough forming there. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video or join us on our Hurst Cycles Discord server. I look forward to hearing from you.